We now begin with the next section on financial reporting and analysis, FRA, and we're going to look at the balance sheets now in much more detail as compared to what we have already seen in the previous sections. Now, the balance sheet, as we remember, is the statement of assets and liabilities that a company has, and it's a statement that is on a point of time. It'll tell us what is the position of the company's ownership of assets and the company's liabilities, what it owes to others at any given point of time, right? So during the course of this unit, we're going to look at what are the major components of the balance sheet, what are the uses and limitations of the balance sheets. We'll look at a sample balance sheet and then try and understand the individual headers in the context of balance sheets. We will try and use a slightly more complicated balance sheet so that we get a complete list of headers that come across us, and we can then go ahead and look at those in detail rather than taking a simple one, so that tomorrow if you pick up a simpler company, it's easier for you to kind of go and comprehend those data points, right? Then in terms of the assets and liabilities, we're going to look at the various types of assets and liabilities that are there, which is current assets, current liabilities, non-current assets, non-current liabilities, common size statements while we make the balance sheets to make them comparable across years and across different entities. And what we can learn from the balance sheets is what we will try and gather, right? So what do balance sheets tell us? What is the information that is available to us? And why is it important to kind of ensure that we understand balance sheets of the company well before going ahead, right? Now, remember that in general conventional analysis, most of the times the media talks about, or news items talk about, the profit and loss statement. We are extremely focused on what's happening with the earnings of the company, what's happening with the sales of the company, what's happening with the margins of the company. Basically, there is too much focus on profitability, right? While that is not wrong, because the purpose of the business is to run it profitably, but there could be a possibility where a firm has profits but lots of debt, right? Now, some of these things we will only understand if we are actually able to decode the balance sheet better, because that's where balance sheet information becomes very, very important. What we owe to others, what have we already received, those kind of data points are available in the balance sheet, and hence it's a financial statement that gives an idea about the financial health, current financial position of the firm. Always remember, it's a snapshot, right? So we've discussed this in the past. It's at a point of time. It's termed as a balance sheet since it represents an equality. Sources of business, sources of funds have to equal to the application of funds, correct? And we've already seen that sources of funds are my liabilities and application of funds are my assets eventually, correct? Now let's go ahead and dig deeper into understanding this. We'll just quickly recap that your balance sheet is on a particular date, right, or at a particular point of time, and then another date is where you will create another balance sheet, and you go from point A to point B. You might be doing some business in between, and those business activities basically ensure that there is going to be some change in the balance sheet. If there is no business activity, there is going to be no change in the balance sheet. The balance sheet will stay where it is, right? So that's the crux of the broad understanding of the balance sheet. Now we dig deeper into understanding what are these individual components of the balance sheet. How do we understand those components of the balance sheet? Remember, every balance sheet on the liability side will divide itself into current and non-current. We have already seen the basic definition of current and non-current. That's greater than 1 year, that's less than 1 year. Similarly, on the asset side, you will see the differentiation in terms of current and non-current. Usually the non-current ones are listed above because those are the longer terms one. Again, current is less than 1 year and non-current is greater than 1 year. I made a mistake there. Non-current is greater than 1 year. That's the broad classification. Now, what are these current assets? What are these current liabilities? We will understand them in a bit, right? Let's first understand what are the uses of a balance sheet. How can I use the balance sheet? Now, the balance sheet of a firm gives us an idea about the firm's solvency, which is, what do we mean by solvency? Ability to repay debt, right? That's called solvency essentially. Can they borrow money? Will they be able to give it back to the liability guys? Will they be able to repay all their liabilities, right? Long term, short term, everything. Will they remain solvent? So a company that is solvent means a company that can pay its stakeholders, all stakeholders, right? That's what we'll use the term solvent as, and that's what solvency is available, because it tells us how much of the liabilities. We can look at the liabilities, and liabilities are going to get constructed by, the equity and the debt. So it tells us how much is the debt component of the overall liabilities. Are the assets enough for the firm to be able to repay all the liabilities? Remember, in this equality, when we say equity plus debt is equals to all the assets, that's because liabilities are equal to all the assets and liabilities are equity plus debt essentially. It means that if you sell all these assets, you should be able to repay all the debt and you should be able to repay all the equity holders for the money that they have pumped into the company. Correct? That's the first part that comes in. The second part is liquidity, which is basically what is the cash position of the company. Does the company have enough cash to take care of any necessarily short-term requirements, right? In the short term, so liabilities could be long-term and short-term. The short-term ones is what we are looking at when we are looking at the liquidity position. So in the context of liquidity position, does the company have enough money to be able to deal with all the short-term scenarios is what comes under the liquidity analysis that balance sheet tells us. And finally, if the firm is solvent, if the firm is liquid and it has repaid all external liabilities, which is the debt guys, does it have enough money to provide to the shareholders? Will the shareholders really get anything after the company, let's say, chooses to repay all the debt? That's where the analysis of the balance sheet becomes very, very important, right? Now, what are some of the limitations? Balance sheet elements should not be interpreted as market value. There is some backdrop to this. In terms of accounting, the balance sheet elements, especially the assets, are usually carried at historical cost, right? What do we mean by historical cost? So if I take a factory, I buy a factory, I will take it at the cost price. Even if the market price goes higher, I will keep it at the cost price at most points of time. So the balance sheet elements are interpreted as, a basic fair value, but that may not necessarily be the market value, right? I may invest certain money in some sort of assets, but the market may value them differently. I may go and buy a company and pay 2000 for that company, but the market might value that only for 1000, right? So it could go both ways. That in some cases, the balance sheet values are typically known as book values. Now, book values of assets and liabilities may not be equal to the market value. And that's one of the limitations from the balance sheet, because the balance sheet sometimes does not give the picture on what should a particular stock trade at, because all it gives is the equity book value. It does not give the market value. We'll look at this in more detail as we go along, right? Uh, for example, if you were to just simply look at a company's value, how would you term a company's value? How would you find out the value of a company? So let's say you're standing here today, right? That's your point where you're standing today. The value of the company should be all that the company has done in the history and all that is expected in the future, right? That should be the total value of the company. So history plus future is the total value, expected value of the company. The stock of the company will trade at this value in the market. However, the book value is only the history component. So equity, if you take a look at the equity is share capital plus the reserves and surplus. What are reserves and surplus? All the undistributed profits till today. So the book value only looks at the left hand side of the portion. If the company is generating value, if the company is profitable, so if company is profitable, that means it will generate value in the future, then the market value should be greater than the book value, because it should be book value, which is the historical portion plus what is expected in the future, correct? So that is the crux of understanding that balance sheets sometimes underrepresent the value that a company could have. In certain cases, they could also overrepresent the values that the company should have. So if for most firms, it consists of a mixture of values. It is typically carried at cost price based on the conservative accounting principles, and that creates a little bit of a problem in terms of gauging the balance sheet items so easily. That's one of the limitations that comes in. Also, it gives data as on a point of time. Now, that's not necessarily a limitation. That's just the way it is. The construct of the balance sheet is such that it will give you data only on a point of time. And that's what a balance sheet is supposed to do, right? It's not a periodic statement. What are the various types of assets and liabilities? We've already seen current assets, current liabilities, non-current assets, non-current liabilities. We will look at each of these in detail using an example of a company. Current assets are assets that can be easily converted into cash in less than 1 year. Current liabilities are liabilities that have to be paid in less than 1 year. Non-current assets are assets that will give you a value over a period of 1 year. Non-current liabilities are liabilities which you have to basically pay over a period of 1 year, greater than 1 year, right? Now let's look at examples. Cash and cash equivalents, they're readily available as cash, so that's not a problem at all. That's an immediate current asset. Marketable securities are securities that can be quickly converted to cash. You can market it, you can sell it and convert it to cash, and that basically becomes your current asset. Accounts receivable, money to be received from someone in lieu of sales, inventories, other current assets. We will discuss all of these in more detail in subsequent sections. Current liabilities will look at accounts payable, notes payable, any kind of accrued liabilities that are there, and any kind of customer advances that are there. We will again look at those in more detail, but anything that has to be settled in the next 1 year will come under current liabilities. Non-current assets will typically include your factories, plants, equipment, machinery, any kind of investment in property, land, etc. It will also include, so these kind of assets are typically called as tangible assets. Why? Is because you can feel them, you can see them, you can look and touch them, right? There are some assets which are intangible assets, like what is the brand value of the company? If the company has some patents, right? We know about patents, that you can file for a patent where let's say you produce something, and pharma companies, for example, the healthcare companies will produce certain kind of medicines. They sometimes have patents on these because they do a lot of research there. That's what is, they can file for a patent and they're given a patent which basically tells that these are the guys who have done the research and no one else can copy this for a while, right? The same in the form of any kind of literary work is copyrights, right? So an author retains the copyright of his book. No one can copy the book if permissions are not taken, right? Similarly, trademarks, brand names, etc., all of those are intangible assets, right? We associate the trademark of a company with some sort of a value. We go and buy Coke because of the Coca-Cola color, the way it is written. All those are registered trademarks, right? And there's a certain value because the moment you look at that symbol, you immediately recognize, okay, what is the brand that we're talking about, right? Then there could be non-current assets, which are financial assets, investment in stocks, bonds, derivatives, real estate from the longer term perspective, right? We will again look at this in more detail as we go along. Non-current liabilities are long-term financial liabilities. You could have bank loans, you could take notes from government, or you could take bonds which are there. There could be some derivatives. Derivatives are probably going to be beyond the scope of our understanding at this point of time, but let's just say there are some financial instruments that could be there that have to be paid in the long term. Then there are some deferred tax liabilities. Now, what happens is sometimes the companies pay and account for income tax separately. I'll give you an example in one of the subsequent sections about deferred tax liability and deferred tax asset. So income tax payable in future periods, because today I chose to pay less tax as a result of temporary differences in what tax I accounted for and what tax I paid for, will create what is called as a deferred tax liability. You could also have something called as a deferred tax asset, wherein you probably are going to pay that you've paid more today, so you're going to use that over a period of time, right? So those are the various kinds of non-current liabilities. We're going to look at all these in more detail with respect to a particular example. That's a sample balance sheet. That is what a sample balance sheet would look like. So we're going to look at this in more detail as we go along. This is Tata Steel Limited and its subsidiaries, right? We also see a term called consolidated balance sheet, right? So we will try and understand first what do we mean by a consolidated balance sheet. At this point of time, it only is required that we broadly understand how does consolidation work. Let's say there is a company, Tata Steel. It holds a stake in company A, B, and C. Tata Steel is 100% stockholder of A, which means the entire equity portion in the balance sheet of A comes from Tata Steel. In B, Tata Steel holds 60%. In C, Tata Steel holds 20%, right? Which are the companies where it has substantial control, right? So companies where you have substantial control. Substantial control is anything greater than 50%. Technically 51%, but I'll just keep it to 50%. So these are called as subsidiaries, right? So that's my subsidiary set. If I was to create the subsidiary set, Tata Steel has substantial control in A and B. It may have reasonable control in C, but it does not have substantial control in C. So when you combine the financial statements of Tata Steel plus A plus B, the combined statements are known as consolidated balance sheets or consolidated statements, right? We will talk about combining these and what are the broad principles that are used in a separate point of time. But if you're combining these statements to give an idea of the entire business family, right? Tata Steel plus A plus B, wherever they have complete control, that's called consolidated statement. And you will see consolidated balance sheet, consolidated P&L, and consolidated cash flows as well that are available when you're looking at these firms, right? You will see that the balance sheets are available for 2 years, so 2015 and 2014. That's taken from the annual report. Typically, it's a comparative number. On the top of this, you will find equities and liabilities, equity and liability. On the bottom, you'll find assets. Broad classification is shareholder funds, non-current liabilities, current liabilities. We have clubbed these together, right? There are some other items here, which is preferred shares, hybrid perpetual security, and minority interest. We'll discuss this later. Don't worry about it. But all this is basically non-current. This is current, right? Similarly, all this is non-current assets. You have fixed assets, you have goodwill and some other assets. We'll discuss them separately. And this portion is current assets. You will see that the total of all your liabilities is going to equal the total of your assets at any given point of time. The independent considerations that we will look at these items individually, those will come in subsequent sections where we start looking them one by one. We'll start with each of the sections. We'll start probably with current assets, go to current liabilities, then non-current assets and non-current liabilities one by one, and we'll try and decode all those as we go along, right? That's what a sample balance sheet would look like. That's where we would end this particular video. Couple of questions as we end this. Explain what do we mean by a balance sheet. Let's recap that. And what do you think are the broad uses and limitations of the balance sheet? Thank you.